Howdy, Jacob here. Today we're looking at Academy Sports and Outdoors in the specialty retail industry. 3.9 billion market cap, slightly higher enterprise value. To me, they're kind of like a mixture of a Dick's Sporting Goods and a Bass Pro Shop. So they do have they have some online, they have sales online, but they also have quite a bit of stores as well. And I saw this for the first time on the Magic Formula. Uh, the Magic Formula ran maybe in 2022, I believe, and pretty decent margins here. 30% on the gross margin side, still double-digit operating margin, with pretty high mid-teens return on invested capital. Balance sheet shows 348 million cash on hand with 485 million long-term debt, 3 million short-term debt. So you're only looking at about 150 million net debt, and they're produced on a 5-year average basis. I mean, it's been pretty high, pretty low, but positive since 2019 and probably 300 million or so. So that 485 million long-term debt is definitely not a concern. Your use of cash is a little bit of debt pay down, a dividend that pays out 0.8% yield, and that is maybe 15-20% of their free cash flow, and a heavy amount to share repurchases. So majority of their money is going towards repurchasing shares, a little bit to debt reduction, a little bit to that dividend paid. And I mean, simple enough. Let's get ready to make some assumptions here. So revenue side, big jump from COVID, and it's probably normalizing. So I think I'd be pretty comfortable with maybe a 2%. High return on invested capital, but again, it is retail. So maybe 12. Margins have been higher. I love that free cash flow is a bit higher. Share repurchases, 1% would be about 40 million. Offset stock-based compensation, 60 million. So you're looking at about 100 million, 140, 280, about 4%. Okay, so let's say 4%. This would be about 200 million of their free cash flow, which is that's 100% of their 5-year average. So maybe let's do 3%. We're saying about 75% of their 5-year average free cash are going towards this, 15 to 20% to the dividend. And the debt they've paid down debt historically, especially the last 6 years, but they don't have nearly as much debt as they had in the past. And so I think that's fine, leaving just maybe 10 to 20% to debt reduction, making acquisitions, reinvesting. So I think that all makes sense to me. And yeah, we just get to a price. Oh, the dividend, do I want to increase that? Let's see. Not a long history of it. I'll probably just increase it with their revenue. So this is just basically saying through the next 7 years, we're keeping the 10 to 20% payout ratio on the dividend side. Majority of it going to share repurchases. And that gets us to a pricing is about 33% before you get the return we're looking for here. I do think it's a good company. It is in the retail sector, so I'd be a little bit skeptical about it, but the margins are pretty solid and very solid return on invested capital. So hopefully you enjoy the video. Have a great day. Thank you.